Okay, ladies and gentlemen, welcome to MACROACE with your host, Tony. It's been about a couple of weeks or so, or well, about a week or so since we had our last live stream. So hopefully you guys can all hear me all clearly. Let me know if you can't, and then we'll get on our way. All right. Great. So you can all hear me nicely and loudly and clearly. So let's get into it then with the Bank of Canada rate prep. We've got about less than 15 minutes to go. So let's start off with how it affects the markets. Well, with the currency, usually if the central bank is more hawkish than expected, or let's say they raise rates, and particularly if they decide to, for whatever reason, raise rates at this meeting, then that would provide some bullish upside movement to the Canadian dollar. And then on the other side, for the stock market, usually, again, if the central bank is more hawkish in their commentary and also in their press conference too, then that can lead to some downside movement, some bearish reaction for the stock market in Canada. But it could also mean that if the central bank is more hawkish than, if they're more hawkish than expected, or are not being as dovish as the markets would expect them to be, then it could also flip and change the script for traders when they're betting on what other central banks might do. If the Bank of Canada is already in the point of looking to make that, has already made that pivot and is looking to decide when to cut rates, then a flip of that sentiment would then provide that volatility from the confusion and then the uncertainty then that causes from those potential comments. But that's not likely to happen today. More or less, kind of standing pat on what's already been said in the previous rate decision. And let's go on to the bond market. Usually, what happens for bonds? We're focusing on bond yields. If the central bank again seen as more hawkish, same reaction as the currency, would potentially see some upside movement in a bullish reaction instead. And on the flip side, if the central bank is more dovish than what they're expected to be through the headlines that come through or the statement that they provide, then that could provide some downside movement to the bond market instead for bond yields. Now, this is always important for central bank interest rate decisions, is you have to focus on not only the figure, but also the statement that comes through. And the statement can take a little bit of time to kind of weed through what's new, what's old, what's a surprise, what's not a surprise, to then make your own informed decision as to whether to jump into a trade or not. Part of the reason that somebody could jump into a trade maybe early is because of the market reaction that has been provided from the rate statement and from the rate decision alongside the statement. So there could be that fear of, the FOMO of missing out on maybe a bit of a spike before actually making an informed decision as to why is there selling or buying going on for the Canadian dollar or in the stock market or bonds, for those reasons. So it's very tricky to then make a decision, but that's why rate decisions are always tricky, because of you have the added risk of what the statement could provide if the central bank keeps rates unchanged as what they're expected to do today. All right, now, so where is the economy at the moment? So inflation continuing to tick down quite nicely to 2.9% from the prior 3.4%. CPI trim, or what is also known as the core CPI, ticking down as well, 3.4% from 3.7%. And then you have the GDP quarter-on-quarter annualized data, which was stronger than what the markets were expecting, and also what the central bank was expecting too, compared to the Q3 of -1.1%. Employment change was slightly stronger, 37k compared to 0.1. Average hourly earnings ticked down as well, something that some analysts cite as not being very reliable in gauging wage prices, or how that could have an overall effect on inflation. And then the broader picture of what the central bank is focusing on. But just to note, it did tick down to 5.3%. Then the unemployment rate also ticking down as well. Retail sales was stronger than expected, compared and stronger than the prior figure at 0.9%. PPI year on year slightly weaker. The raw material price index at 1.2%, so much stronger than the previous data. And then manufacturing PMI also stronger as well. So remember, the Canadian economy is based off, it's a commodity-based currency, with their exports being heavily reliant on their exports of commodities to other nations. So having a look at, although the PPI and raw material prices index don't really have that much of an effect on the markets by themselves, but when you look at the overall picture, you can see that it's a bit choppy in regards to prices that these businesses are paying for the raw materials. But the prices are still going down for producers of those goods or goods and services that they're providing. But the key point is that inflation is headed towards the 2% goal. We're looking at the headline in inflation. Core, still a little bit more work to do, and something that the central bank today could highlight in their commentary, that core data still needs a bit more work, and they could reiterate what the Fed have said, is they need to be a bit more confident with where inflation is headed before they can make a decision as to when to cut interest rates. Currently, at the moment, there are, according to the overnight index swaps for Canada, there's a 63% chance or odds of the central bank cutting their rates in June. So if we do get, let's say, more hawkish than expected commentary, if they expect inflation, if they feel that inflation might tick back up again, then that could throw a bit of a spanner in the works for those bets, or for what the markets might be expecting the central bank to do this year with their rate decisions. The Bank of Canada, then, if we're looking at first we need to go through what the previous statement has said and what the prior statement to that statement had also said too. So if we're looking at the prior statement in December, it said that they were still concerned about the risks to inflation. They did drop October language about inflationary risks increasing. So again, the reason why we're going through this is because the headlines, or the things they say, that if they've removed it, if they've added it back in for any reason, then it could mean that they're more hawkish or dovish than what the markets might be expecting. Hence, we're going through these comments here. They said that higher rates are clearly restraining spending. Labour market continues to ease, even though job vacancies have declined further and jobless rate has risen modestly. Wages are still rising by 4 to 5% on an annual basis. Then the latest one that we've had in January, they said they expect inflation to remain close to 3% in the first half of this year, easing to 2.5% in the second half, and then returning to the 2% target in 2025. Now, in October, it said that it would hit the target by the end of 2025. Very small difference, very small change, or in the language that's used. Rather than inflation hitting 2% by the end of 2025, they're expecting to return in 2025. If they, for whatever reason, go back of themselves and they expect inflation to hit 2% by the end of 2025, of course, that would be more hawkish than expected, and then could provide upside to the Canadian dollar off of the back of that there. Also, is where they expect inflation to be within this year too. If they don't see for instance, inflation, if they don't see inflation easing to 2.5% in the second half of the year, which is when the central bank is expected to start cutting rates, then that could provide some upside movement potentially to the Canadian dollar. On the flip side, if they expect inflation to be lower than 2.5% in the second half of this year, that could provide, again, that's more dovish, and could provide a more bearish reaction to the Canadian dollar instead. Is everyone clear so far on the differences and why we've kind of gone through that? If you're not, then I can go through it in a little bit. We've got about 4 minutes. So money market reactions. Canadian money markets see 40% chance of a Bank of Canada rate cut by April, down from 65% before the policy announcement. The meetings from the February 7th meeting as well. So the Governing Council saw risks of inflation being more persistent than expected, requiring rates to stay restrictive for longer. They discussed risks that monetary policy could have greater than expected impact on consumer spending, requiring lowering rates earlier and more quickly. The Bank of Canada is particularly concerned about persistent inflation and lowering rates prematurely in the January policy setting meetings as well. So the difference between the meeting minutes and the statement is what they've agreed upon to say, and the minutes is, of course, what is discussed. And that provides a bit more extra detail, considering the Bank of Canada only started doing this towards the end of last year, of providing providing the meeting minutes of their central bank rate decisions. So provides a bit more color of what members are feeling as a whole overall. And you can see here that they're still not on that trajectory of saying that they're still on that. It's a similar path to other central banks, that it's too early to, if you lower rates too early, that there could be a jump in inflation, and then that could then derail the central bank's goal of bringing inflation down to 2%. So confidence in inflation is what they want to see. If they feel confident that inflation is headed towards a 2% goal, that would be different from them saying that they're looking for confidence that inflation is, or they're waiting for confirmation that inflation is headed towards a 2% goal. Do we get that difference? They're confident that inflation is headed towards a 2% goal. And the opposite side is that they're waiting for data to then be confident, or they need more time to be confident that inflation is headed towards a 2% goal. One, being that they're confident that inflation is headed towards a 2% goal, would be seen as more dovish. And on the flip side, if they're still waiting for if they're still waiting for data to be more confident, that would be seen as more hawkish. So these are the little nuances we just have to be careful of what the markets could pick up on, or have picked up on within the statement when it's released. And then commentary from central bank members, you don't really get a lot of commentary from them. But Macklem on January 24th said it's premature to discuss a rate cut. The risk of another rate cut is not zero. That they want to see inflationary pressures continue to ease and be clearly on a downward momentum, and see clear downward momentum in underlying inflation, or the core CPI data. Deputy Governor Gravel said that we didn't spend a lot of time talking about hikes this time. So that it's not completely off the table, depending on how inflation goes. And we have seen a nice decline in inflation. So the potential then for the central bank to maybe mention that rate hikes are still on the table diminishes even further. And it could be something that could just be expected from the markets. So you might not get potentially too much of a reaction from that if that does come into the rate statement again. Sentiment and views then. So as said, so this was back around, well, this was around the at the end of last week. there was a 51% probability according to Canadian overnight index swaps of the first rate cut to happen in June. Now it's about 63% of that. Bank of America say they maintain their base case for June rate cut and for dollar CAD to stay above 1.35 for the moment. They expect a faster and deeper cutting cycle than the Fed, and they finally note that the surprising core CPI data, which leaves the door open for a cut in April. So this is why we need to see the change in language, that they are confident that inflation is headed towards a 2% goal, and that they're more open to the possibility of a rate cut sooner rather than later. Later on, well, about a couple of days ago, you had CIBC. In their note, they said that the Bank of Canada will likely keep its cards close to its chest in terms of shedding light of when we could expect the first rate cuts, opting to wait for a new forecast in the April monetary policy report to fine-tune its message. And they say changes in the statement could simply acknowledge both modest overshoot versus its growth forecasts, of course, with the GDP quarter-to-quarter annualized data, and some improvement in core inflation trends. They say that the bank likely wants to see some additional slack in the labour market as well. So CIBC's point of view that they're not really going to give away when they're looking to cut rates makes it, would of course, as any other interest rate, makes it even more difficult to determine whether or not you should buy or sell the Canadian dollar. And that's where the point is that you have to keep an eye on the language changes. And there might not be any language changes. They could repeat what they've said before. And the markets will have to probably then wait for April for that decision to then get a more crystallized picture of when the central bank will either they do decide to cut in June, or whether they decide to push it further, depending on how inflation data is in the future. Okay. What else we got here? So this is the last rate decision from if we're looking at the market reaction, you'll see there's a bit of a quick whipsaw on the Canadian dollar. So there was an initial bit of strength that had occurred. Let me kind of go back. I did kind of skip it a bit more than I should have. Okay, I'll just kind of find. Okay, this is just before the rate decision. Rate statement comes out. Rate decision comes out, remains unchanged as expected, and then you can see that there was the initial strength from the Canadian dollar off of the back of that data. But you've also got to bear in mind too, they had the S&P manufacturing PMI data at the same time, which was also stronger than expected. So from the dollar strength that was then provided from that data, from the US data, the Canadian dollar had also seen a bit more of a bit more strength from their side. So what it means is the strength was just provided from the US release. Today, of course, you have Fed's Powell speaking, okay, at 10 a.m. Eastern time. We've already had some commentary from him in the morning about the repeating that they don't expect it will be appropriate to reduce policy rate until they have greater confidence in inflation moving sustainably towards a 2% target, and it will likely be appropriate. It will likely be appropriate to begin dialing back policy restraint at some point this year. So there was a little bit of a strengthening from the dollar already today, and then after that, after a while, it had gone back to what it was its original movement, and started heading downwards a little bit. But the other risk that we have to consider with the Bank of Canada, today, is the JOLTS data too, and how will that affect the dollar? Because then that could also have an influence on the Canadian dollar if the rate statement is lackluster like it was last time here. There weren't any surprises or anything to shock the market. if there were any surprises or shocks that the Bank of Canada provided that go against sentiment or above it, then you probably would have seen the Canadian dollar continue to strengthen for longer if the central bank was more hawkish than expected. So that's a risk we have to be aware of, is how does the JOLTS data perform too? If the figure is stronger than expected, that could provide some upside to the US dollar, and then in turn some to the Canadian dollar. But we will be looking at the other currency pairs, such as GBP CAD as well, to see how much of an influence has the JOLTS data had on the Canadian dollar overall. So that's up there. Let's kind of skip forward and see what the rest of the reaction was. You can see, yeah, as I said, not really that much, and the market kind of continues on as to the way it was performing later on. So let's get out of this here. Let's pause that. Let's get out of here. Okay. Let's see. GPCAD did have. Let's kind of look. Okay, so on the hourly, this is where we are, or what we're looking at. So if we're currently looking at our ranges, we're near that point here at about 1.724, and then at the high point of 1.729. So depending on how the central bank plays it, if they're more dovish than expected, there is that potential area here on the support line, where if they are more dovish than expected, it could potentially go through that, or if it's not as dovish as expected, we could be playing around that area on GBP CAD. If they're more hawkish than expected, then it does seem to be you would have quite a bit of ways to go to get to that resistance area here at about 1729 at around there. So that's something that we've just got to be aware of what we're looking at too. What kind of playing field do we have with the Bank of Canada rate decision? On top of that, we've also got the US data too. So how much will that influence the data today and the Canadian dollar? Well, that's of course yet to be seen. And that's why it makes it more difficult when you have other releases that the markets might be focusing on, might put more emphasis on if the central bank statement isn't that great, or let's say it's boring, or there are no strong shifts towards a hawkish or dovish side. So let's get out of there. Okay, right. So let's go through the ranges and deviations as well of the past market reaction. We've got about less than 10 minutes, so let's open up there here. Also, another thing I've done with the ranges and deviations, not only have I provided the high and lows for the forecast for the economic releases, but you also have the expected deviations too that are listed on the right hand side here. If you're subscribed to the MACROACE mailing list, of course, we'll have access to this, to the link to be able to see the Google Sheet, not only of the ranges and deviations of the upcoming economic releases that are always updated, but also of how the markets have performed in the past as well. So with Canadian employment change, non-farm payrolls, if we're looking at the Bank of Canada today too, we've got that here of what the last market reaction was, what was the sentiment. And here we noted that they had the US data that was stronger than expected, which led to dollar strength. So here you have all the information you need as to how strong were the market reactions to the economic releases. Okay, and for central bank interest rate decisions, we give you what the sentiment was. What did the central bank say? And if there's anything else that was going on. So you can see here in the past where you've had, if we're going back to the 6th of September, 23, when you had the ISM data that was stronger than expected, led to dollar strengthening, and you had a stronger reaction. You had a stronger reaction from dollar CAD, even though you had the central bank that didn't, and at that point the central bank didn't provide anything new. So there was some more of a mixed reactions there. So these are the kind of things that traders need to kind of be aware of and what's happened in the past. And then you make your own decision as to what could happen in the future. In this case, if there is another rate, if there is another US release stuck alongside, or if it is stuck alongside a central bank decision, what are the markets going to focus on more? How much of an influence could the other data have on the markets? Okay, does that make it clear? So we can see that the biggest market reaction that we had last time was on GBP CAD, and then we had CAD JPY, Aussie dollar CAD, the Aussie dollar, then you had the New Zealand, the euro as well, and then the Aussie dollar, the New Zealand dollar, and then dollar CAD, and then Swiss franc as well. So the biggest market reaction. This has kind of been a little bit mixed sometimes in the past, but generally we have seen the most or the strongest move coming from GBP CAD from the Bank of Canada releases. Sometimes, if we're looking at the Canadian employment change, you might have other areas that are stronger, other currency pairs that might perform stronger than GBP CAD sometimes. But generally, we've seen is that GBP CAD has had the biggest market reaction to the economic releases. Okay, so I hope that everyone's, and the way you can get access to this here for the ranges and deviations sheet, I said it's completely free. All you've got to do is subscribe to the MACROACE mailing list and you will get access to the ranges and deviations on the Monday morning or before the US session begins of the week ahead of what to expect. And it's a very I have added some stuff to it to make it even better for the week ahead of what to expect from different investment banks. Just some research that I've added in, but still it is quite simple. It gives you the expectations for US, Asia, and the European sessions, the links to the live streams, and of course, as said, the link to the Google Sheet here as well. So as said, if you already have used in the past and found it useful, don't forget to let me know. Send me an email at tony@financialjuice.com. It would be great to get your reviews and feedback. As said, I did update how the ranges are presented as well. You see the units of how presented have been updated, but hopefully this kind of makes it more clearer as to, rather than have to make up your own mind as to or having to do your own calculations, it's just making it simpler. That's all, in a nice way here for the upcoming economic releases. So hopefully you guys find that useful too. But yes, if you do subscribe today, you'll get access to the deviations on the Monday when I send out my week ahead email. So there's one email every week that I send out with the updates of what we're going to be covering or not. Okay, so that's range deviations. We've got less than a minute to go. Let's get this up and going. So hopefully you guys found it useful. Don't forget to give the video a like, share, and subscribe to the channel as well. Get the word out there. Let's get it pumping. Let's see how. Let's see what the Bank of Canada provides in their rate statement. So it's going to take a bit of time to kind of see what way we could go ourselves. Okay, let's see. Setup. So I'm going to go silent at the 10-second timer, which is now. Okay, so I took a couple of trades on there. So on the initial spike from CAD JPY, let me bring up that window here for you, and then just a quick short trade, jumping on that some of the commentary from the Bank of Canada. So let's summarize what they've said. Okay, so what they said is that they need to see further and sustained inflation. They need to see further and sustained easing in core inflation. So that's still, so they're not ready yet to cut interest rates, is what they're saying, before they make their decision. Then, that's what traded off the initial move, and from that continued. Then I jumped on to GP CAD. So initially, where I jumped on for CAD JPY was around there, and then came out. Whoops, and then came out around here also. Okay, that's where I exited the trade. Okay, then the second one, as you saw on the screen there, I did let it kind of go for a little bit, and then I realized that the movement wasn't as strong post the market reaction. Probably from there, could have held it for longer, but exited that trade there. Okay, so that's that there. 2 trades are done so far. And I will kind of see. And also, if we're looking at the level 2, so let me just take this off and make it clearer. What else do we have here? Let's get the Canadian. We should get. Yeah, there we go. Okay. So we have a look at a high time frame. Where are we at the moment? So broken through that level of support that was initially there, now becoming that resistance. See where else we could go, where else it could go from there, but a more hawkish than expected central bank. Okay, off the back of that. Okay. But yes, hopefully you guys all found that useful with the information that I provided. If you did find it useful, don't forget to give the video a like, share, and subscribe to the channel. Get the word out there if you found it useful. As said, also to mention, we have the ECB interest rate decision tomorrow as well. So that the ECB interest rate decision being held at 8:15 a.m. Eastern time, we're going to be doing our live stream at 7:45 a.m. Eastern time, when we'll be going through that there. So just about 30 minutes again for prep on the ECB interest rate decision in that video there. So I've done my 2 trades. That's going to be it for now for me. But as I said, we did break through that bit of support, now becoming a resistance on GP CAD as well. Okay, let me also, don't forget, FinancialJuice is of course where we get the where we are looking at for the headlines, the live voice and text feed as well, all in one place. So let me kind of make this a bit more clear. So FinancialJuice provides a live voice and text feed to keep you up to date with what's going in the markets, what to expect, if there are any geopolitical bits of news that have come out that could have rocked the markets, any central bank speakers as well, all here in one place. So you have your live voice feed here on the, you just see it there, clicked. There we go. The live voice feed here on the top right hand side, where I'm kind of sliding it there. In the center, you have your news feed of the text headlines that have come through. Okay, and you have all the data. So here we go. And then we've also jot down which headline it was that caused the market move. And in this case, it's still too early for the bank to consider cutting rates, and that the bank needs to see further sustained easing in core inflation. All of that there is all in one place. In the middle, on the left-hand side, you have the economic calendar of what to expect for the day ahead, and also the week ahead. Of course, you've got Powell later on, and then you have the JOLTS data, okay, to see how that will then impact the Canadian dollar afterwards, to see if that does or does not have any impact on the data on the Canadian dollar. And then later on, you got the Bank of Canada press conference too. So yeah, all of this is all in one place. Your voice feed, your text headlines, your economic calendar, all in one place, so you can keep up to date with what's going on within the markets in a very quick amount of time as to what is going on. Okay, so if you wanted to subscribe to FinancialJuice as well, so there's a free version of FinancialJuice that you can subscribe to, which is the delayed version. Okay, I'll just put the link in there and pin. Okay, so that's so again, there is the delayed version of FinancialJuice, which is a free version, which everyone signs up to first. Which, as said, when I say delay, there's a delay to the site overall in regards to the voice, the text, and also the economic data that we have on our calendar as well. If it's the first time coming across a live voice and text feed, then have a little play with it, see what you think of it, if it can become part of your day trading tools, which it is made for day traders. Then have a little play of and see what you think about it. If it's something for you and you want to remove and have that extra edge in the markets and go for the pro version of FinancialJuice, we still have our offer for New Year 92, where you can get FJ for $99 for 1 year. So instead of paying about $1,000 for FinancialJuice for a yearly subscription, you can pay $99, okay, for 1 year of FinancialJuice, or you get 92% off. Is basically what it is, okay. And that you can have a little play. You can have a little look here of the details that we have for the offer that we've got there. Okay, so have a little look there. That's a code that we've just a little update. It's called March Madness. So I'll just update the little code there for you. Let me just get it here. March Madness. Okay. Okay, so this is the last link that you've seen here. If you use the code March Madness, then you can get 92% off of with the code March Madness off for FinancialJuice. Okay, so as said, instead of paying $1,100, you just pay $99 for the year instead. All right, so that is FinancialJuice, and that is MACROACE. As to tomorrow, we have the ECB interest rate decision that is to come out tomorrow. The link, which I'll provide you guys here now, so you can have a little look at that later on. You can have a look at that and join us for tomorrow. Let's bring that here for you. Oh, we've also hit 5K subscribers. I believe that was just now. So thank you for jumping on and subscribing to our channel. That's great. Thank you very much. Let's get this link in here. Okay, that's the link for tomorrow for the ECB interest rate decision for the live stream there. All right, so just to make you aware of the FinancialJuice offer that we have for Pro. So we have 25 days that the offer is running for. So again, March Madness, you get 92% off for that code of FinancialJuice. You can get it for $99 a year rather than having to pay $1,100 for the year instead. Okay. All right. So thank you very much for joining me live. As I said, I hope you found that information useful. Did you guys find the information useful? Did anyone have some good trades or not? Either way. Okay. All right then. I'll see you guys tomorrow in the morning. 7:45 a.m. Eastern Time, ECB rate decision. We'll go through the prep of that. Why do you all FX says I subscribe to Pro but no feedback? What does that mean? Shoot me an email. You've got my email address, because I'm not sure what you mean by that. Mazapperman talks with a thumbs up. Good. All right then. So for the final time, I'll see you guys tomorrow in the morning. All right. Take care. Bye.